I'm turning my attention closer to home this morning. So we're going to be looking at what's come out of the UK this morning, starting with DINGRA, a Bank of England member's comments on whether the UK will be in a recession pretty much or not. And then we're going to have a look at the UK data that came out to do with manufacturing and GDP. And then the trade and takeout today is similar to what I mentioned yesterday, but it's going to be that, not having a position is a position. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So yes, the Bank of England's DINGRA says that we think only about 20 to 25% of the impact of interest rate hikes have been fed through to the economy. And this is quite interesting considering some of the literature that I've read on this as well, which says that in developed economies, the minimum time for rates to actually start feeding through is about 25 months. So that's quite astounding, really. The rate hikes began in January 2022. So we're sort of approaching that, 2-year mark at the start of 2024. And I think, there's certainly an initial impact to rate hikes, but really to feed through to the economy, that number of unemployment, needs to start ticking up. I think that's the real indicator of rate rises working, unfortunately. It's just the way that there are the trade-offs between inflation and unemployment when you are coming from a higher base of inflation. He went further and said, when you're growing as slowly as we're growing now, which strange to put the UK down like that when, we're growing faster than many other economies, but we'll keep going. The chances of recession or not recession are going to be pretty equally balanced. So we should be prepared for that. It's not going to be great times ahead. If growth falls by much more than it expects from here, a cut may happen sooner. Fine, but you don't hear other central bankers saying this stuff. It's very, very bizarre that the UK always puts itself down on the global stage. It's very, very bizarre. I don't know why he wants to come out and say something like that. He must be an uber dove, but it doesn't really make sense to me. Maybe he's upset that his house has fallen in value by 5%. Who knows? But the fact of the matter is there was an initial reaction, sterling, and we can see this here. It's been relatively volatile through the last, let's go back to the daily chart, relatively volatile through the last month or so. We've had broad downside moves from that initial spike up to 1.3 in mid-July. And I think comments like this, especially with how this daily's forming, we could argue that there's going to be, a bit of a trickle over this way. So we could start targeting, that support level there down at 1.21. So that's 200 ticks away. So, we'll see how this daily looks. If there's some sort of indecision, which could be indicated there, then fine. Carry on. But I think one of the key bits here as well is how yields behave. So if the yield spread between gilts and US Treasuries decreases, so, the spread in favor of US Treasuries increases, so US yields are increasing at a greater pace than UK yields, then we should see the pound come off further as well. But off of the back of these comments, it's important to pay attention to what these central bankers are saying because they are guiding the rate path at the end of the day. Clearly, he's a dove. Clearly, he is pricing in a cut sooner than what the market expects. And so, it's very, very important to pay attention to him. Now, there's every chance that DINGRA came out with those comments after looking or having a prior than release glance at the UK data that came out today, because it's not looking too great, to be fair. UK manufacturing output month on month, negative 0.8% versus the expected of negative 0.4%. UK industrial output, 1.3% versus expected 1.7%. And the UK GDP estimate year on year, 0.5% versus expected 0.5%, with previous 0% growth. So there's a little bump up there, but it's in line with expected, which is good. It's not great, it's not amazing, but it's good. It's better than other countries at this time. So it's better than Germany, better than France. So happy. However, that means that there is a higher base to come off of, and with this underlying sort of more minor data where you've got manufacturing output faltering, you've got, industrial output faltering, might mean that there's some issues. However, what I would say here is that the UK isn't necessarily a manufacturing economy at all. The UK is a service-based economy. And if we look at the services, which should be out either later this month, I believe. It's a couple of different surveys that are released. We can still see that services are doing quite strong. So they are one of the largest output factors in the UK. And this is kind of why I would hazard to think that this is an isolated to the UK issue to do with manufacturing and industrial output. I think it's very much more of a global issue, showing that global demand's faltering. If we look back at the comments I've made on oil, for example, it shows that global demand for oil isn't there, which also has a knock-on effect and a meaning that global demand for manufacturing and demand in general, I guess, is quite flat. So wouldn't isolate this to the UK. I would suggest that a lot of economists and the people that come up with expectation surveys aren't very good at their jobs anyway. So we shouldn't always get anchored to the expectation. We should maybe be looking at the previous quite a lot. But if we do look at the previous, it does show that it's on UK manufacturing output month on month, for example, it does show negative 0.8%, revised negative 1.2%. So the revision was actually worse. So yes, not pretty when you do start seeing concurrent negative prints. And that also goes in line with a weaker pound. We probably need the pound a little bit weaker here, a little bit softer to induce some sort of stimulus effect, if you like. But then you've got the knock-on effect of inflation, and it gets very, very messy. So not doing amazingly bad, not doing great is basically the verdict. And maybe that's where Dhingra was coming from here. As I said, in terms of, where sterling's traded, you can probably look for some downside off of this, especially if we get some impetus from other Bank of England Monetary Policy Committee members saying anything. So yesterday I spoke about, when you're not confident, having a small position in the market. But today I just want to really focus on the fact that sometimes you really, really can just be totally out of the market. And for most people who aren't professional traders, it kind of comes down to, okay, well, how distracted are you right at this moment? Because at the end of the day, not having a position is still a position. You can't lose money if you don't have any money invested in the market. It's just impossible. And so if you're, facing a busy period at work, or you're facing a busy period at home, or you've got other stuff to do, just don't have a position. It's so easy. Because what's going to happen if you do end up going into the market without your full attention is you're going to lose money. There might be one or two times when you luckily end up making some cash, but most of the time you're not going to be able to understand the whole context of what's going on. You're not going to be able to risk manage effectively, and it's just not going to work out. So not having a position is a fantastic position to also have. And myself, I'm very much macro driven, so I'd say 90% of my time is spent not being in a position, to be honest with you. I maybe make decent P&L on 8 trades per year, 8 or 9 maybe, and the rest are just small ticks, basically, just to keep things going, just to keep myself accountable by being in the market. But a lot of the time I'm just totally flat. It just makes perfect sense for me to do that, because you don't always get opportunities, and you do get other distractions, maybe not for myself, but effectively not having a position is a fantastic position to have.